Why growth stocks are better to trade against than value stocks or indexes. Growth stock pros: larger premiums due to higher IV. Options can be sold further OTM. More price movement may result in faster portfolio turnover. More trades may be placed, both CSP and CC. More price movement may mean faster price recovery after being put. Growth cons: these are stocks yet to fully prove their business case. Thus there's the risk they won't succeed and may never recover from resultant price falls from changes in investor sentiment about the stock. Growth stocks decline far more in price than value stocks in market corrections, yet more again in market crashes. Value stock pros: less volatile stock price moves. Stable, more proven businesses can benefit from flight to safety in corrections and crashes. Value cons: significantly lower premiums, circa 1 to 1.5% per right. At 30 delta, less stock price movement range may result in slower price recovery on being put. Lower IV will result in lower or even unviable premiums on CC rights. There's no law to say that value stocks will always be safer than growth, or that growth will always outperform value. Over any given period of time, growth or value may do better. There's no statistical clear-cut winner between growth stock and value stock performance over the long term. Trading against either growth or value stocks could work out better in different market conditions, which we can't predict the timing or duration of. Generalizing: growth stocks do better in bullish sentiment markets and value in bearish. We're trading a bullish strategy. The market's majority opinion, which has the option pricing model assigning a higher IV to a growth stock, ascribes the growth stock a higher probability of price moving, whilst a lower IV value stock is less likely to do so. However, there's also no law to say that higher IV stocks will always see more price movement than lower IV stocks. Volatility can rise or fall for any number of reasons. Both high and low IV stocks have the potential to fall in price, but the lower IV price action of a value stock means price may be slower to come back than for a growth stock. Value stocks are more lowly valued for a reason and can become value traps, where earnings growth is insipid and the market is uninterested in bidding the stock price up. IV falls very low from the moribund stock price movement, and CC options premium prices fall to the point of not being worth the write. Perhaps the only way to get unstuck from this position would be to sell the stock and transfer the capital to a growth stock trade. Value stock pricing and performance includes dividend income returns, which are irrelevant when selling cash-secured puts and not owning the stock. We're trading the options, not the stock, and the fact that growth stocks pay circa 3 times more premium return versus value is far more beneficial to our portfolio returns. For example, our parameters in choosing a growth stock for a CSP right are circa 4% premium for a 30 DTE trade at a 10 to 20% OTM strike, which should be around 30 delta 30% assignment risk when trading against a traditional value stock, such as a major bank, or a mature growth stock, such as Apple. At 30 delta, strike price will be circa 5% OTM. Premium return will be circa 1.25 to 1.5%. Black-Scholes pricing shows it's more risky trading options against value stocks because for the equivalent 30 delta, 30% assignment risk, value stocks pay circa a third as much premium, at circa 2 or 3 times closer to the money ATM than do growth stocks. Due to the wider price ranges of higher IV growth stocks, we're more likely to be in the market selling for acceptable premium returns for longer periods of time. Due to the faster decay of OTM options, we'll have quicker trade turnovers. The higher returns from growth premiums and faster trade cycles equate to a larger portfolio value. A larger portfolio value enables larger rights, higher returns. Larger accumulated return is a larger cushion against downside risk. The contention that higher return must equate to higher risk doesn't necessarily hold.